Hey everyone, Shawna Downs here, Mortgage Loan Originator. I wanted to go over with you some information about the home buying process and hopefully answer some questions that you may have. I also want you to write down any questions that you have during this process and make sure that you send those to me because I'd love to answer them for you. All right, let's get started. Is it the right time for me to buy? So buying a home is a very exciting experience, but it can also be challenging and overwhelming with all the necessary paperwork and verifications you have to go through. So while it seems tempting to start looking for a home first, there are steps that you should take to help you have a good home buying process. So before you begin to start looking for a home, you want to get pre-qualified or pre-approved. What is the difference between pre-qualification and pre-approval? So pre-qualification means that I have pulled your credit and you have stated your income and assets to me. Pre-approval means that I've pulled your credit and I've also verified your income and asset documentation. This is important because when you go to put an offer on a property, a seller is going to want to see that you actually have a pre-approval, not a pre-qualification, because they know that I've done my due diligence as your loan officer and that I can actually affirm that you are able to purchase that home, that you can afford it. So this is why it's important that you want to get to the process where you have the pre-approval when you're going to put an offer in on a property. How does my credit play a role in getting pre-qualified or pre-approved? So there's 3 credit bureaus. There's TransUnion, Equifax, and Experian. And a mortgage company will pull all 3 of those bureaus and take the middle score of the 3 bureaus. Each bureau gives you a credit score based on several factors, some of which are how much credit you have, how long you've had those accounts, how high your balances are in comparison to how much you owe, and your on-time payment history. So what accounts are listed on a credit report? Credit cards, auto loans, student loans, collections, judgments, tax liens, bankruptcy, and also any previous mortgages as well. There's also hard inquiries that show up on your credit report for any credit that you are applying for. So just keep that in mind when you go to apply for a new account or a new creditor, that you'll have those inquiries on there as well. Now, I want to give you a couple of tips on your credit. So one is make sure that you don't use more than 30% utilization of your credit cards or your revolving credit. Once you get over 30% utilization, it starts to bring your credit score down. Also, don't open up any new accounts. Unless your loan officer advises you otherwise, make sure that you don't open up any new accounts, any new credit. I know that it can be very tempting to open up that Home Depot card, especially when you're buying a home, but you want to make sure that you're not going out and opening up any new credit while you're going through the home buying process. Don't go out and buy a car or a boat or something big like that either. That's important. And then don't close any accounts. So I know that sounds a little weird and you think, well, doesn't it look good that I show that I've paid off my credit card or I've paid off my loan? Well, yes, it does, but also it does negatively affect your credit score when you close an account for a temporary period of time. So you want to make sure that you're not doing anything with your credit during the home buying process. What are the different types of mortgage lenders? So when it comes to financing your home loan, you have many options and all have pros and cons. So you have to pick which one is the best fit for you. So we have banking institutions. They control the process from beginning to end. There's no middleman. However, they are big and they're not always personal, and they can also be limited on what programs that they offer. There are also mortgage brokers. They are a middleman. They do shop for your personal scenario with a third party to get your loan approved. They outsource your loan for underwriting, processing, and funding, and that can cause them to lose control of the loan process. However, I will say with mortgage brokers, they also have an array of different types of loan products to meet any needs. So they can also be very useful as well. Online lenders, they're focused on technology and they can be very efficient. However, they can also be more impersonal and you may not get that personal experience. And then we have mortgage lenders, which is what I am. They have control of your loan process from beginning to end. They have in-house underwriting, processing, and closing. They're also client service oriented. So mortgage lenders really care about that, having a good mortgage experience and that customer service component. What documents do I need to get pre-approved? So you're going to need your most recent pay stubs for 30 days. So if you get paid weekly, you're going to need your previous 4 pay stubs. If you get paid biweekly or every 2 weeks, then you're going to need your previous 2 pay stubs. Also, you're going to need your W-2 forms for the past 2 years. You'll need your last 2 consecutive full months bank statements for all accounts that you're going to use for assets, and make sure that any statements that you do use, that you also include every page, even if they're blank, because it's a legal document. You have to provide every single page. You'll need a copy of your ID, such as a driver's license. You'll also need your federal tax returns or your 1040s for the past 2 years. Now, this is going to depend on the loan product that you are getting. So you may not need your tax returns. It really just depends on the loan product. So your loan officer will let you know if that's required or not. But you might want to have them ready so that you have them available in case you do need them. And then if you're self-employed, you're going to need your past 2 years business returns and a copy of your business license. Now, if you are self-employed or if you get 1099 income, then you'll need your 1040s as well as your business returns, or you may just need your 1040s if you're self-employed, if you have a Schedule C income. You'll need proof of any supplemental income you wish to use, such as child support, alimony, retirement, and investment accounts. You do not have to provide that information if you're not going to use it to qualify. However, if you pay child support or alimony, you will need to provide that documentation because it does have to be included as part of your debt to income ratio or as part of your liabilities. The debt to income ratio is basically the debt, the monthly debt that's on your credit report divided by your gross income, and that gives a percentage. And that every loan product or loan program has a certain percentage that you have to stay within. So this is why it's important to provide that information. And then also any information about long-term debts, such as student loans, if applicable. Sometimes your student loan accounts don't always reflect current information. They don't have all the information. So sometimes you may have to provide a most recent statement in order for us to verify that information. Okay, what is my monthly payment made up of? It's principal and interest, property taxes, homeowners insurance, mortgage insurance, or MIP if applicable. So you'll pay one payment to your mortgage company every month, and they will divvy it up between your principal and interest, and then they'll put the additional amount, which is for your property taxes, your homeowners insurance, and your mortgage insurance if applicable, in an account called an escrow account. What is private mortgage insurance? So private mortgage insurance is also known as PMI. It insures the mortgage for the lender in case a buyer defaults. So PMI is allowed, or it allows a borrower to put less money down if you're not able to put the full 20% down. Lenders want to see that 20% because it gives them the assurance that you're most likely to pay that loan back because you have more skin in the game, and you're less likely to default on that mortgage. PMI is arranged by the lender, and it is provided by private mortgage insurance companies. PMI is usually required when you have a conventional loan and you make a down payment of less than 20% of the home purchase price. So if you're doing a government loan such as FHA, PMI is always going to be required, and it's the same rate regardless of credit score or loan amount. But I do want to make note that when you do an FHA loan, there is an additional PMI paid into FHA. You'll have it's called MIP, Mortgage Insurance Premium, and it is 1.75% of your loan amount, and it can be financed back into the loan. So let's say FHA's minimum down payment requirement is 3.5%. So you put your 3.5% down. Into you're looking at your loan amount and you're saying, well, this doesn't make sense. This doesn't match up to the 3.5% down payment I put into my loan. And that is because the 1.75% mortgage insurance premium is added back into the loan amount. So you'll see that there's a difference in that loan amount because of that. What costs are involved? So you're going to have a down payment, which is also known as earnest money deposit, and it depends on the program that you choose. So it's going to come off the purchase price of the home, and it lowers the amount that you're going to finance. You'll also have closing costs and an escrow deposit. So closing costs are made up of lender fees such as underwriting, credit report, processing, administrative fees. Those are just to name a few. Also, it includes appraisal fee. An appraiser is the person that goes into, he's a third party that goes into the property and he assesses it and says, yes, this property is worth what you're paying for it. Also, there's attorney and closer fees, such as settlement fees, title insurance, plot plan, and recording fees. And then in addition to that, there's an escrow account deposit. So an escrow account is an account that holds a portion of your mortgage payment to pay the property taxes and homeowners insurance, as well as private mortgage insurance, if it's applicable, when it comes due. All right, we're going to go over a few of the loan products, and these are just a few that will kind of give you an idea of what's out there and what might be a good fit for you. So we have a conventional product called Home Ready or Home Possible. Home Ready is the Fannie Mae version. Home Possible is the Freddie Mac version. It's a minimum 3% down payment. The credit scores can be as low as 620. Income limits for properties based on each county. So you do have to check whatever county you're going to be purchasing in and make sure that you do qualify income-wise. Also, income is for non-occupant borrower also. So if you have, let's say you have your parent or your aunt or uncle want to co-sign for you, let's say that you're just getting started and you're not able to qualify for what you need or what you want on your own, you can have a non-occupying co-borrower on there as well that can help you to qualify. And then you will need home ownership education. They do have their own. It's an online course. Each one is different, and it is a particular one. It's specific to the loan program. So you will need to get with your loan officer to confirm which one you need to take. And again, it's an online course that you'll take. So it's pretty simple. Then we have FHA loans. This is a government loan. It's the minimum down payment of 3.5% down. Credit scores can be as low as 500. So 500 to 579 is a 10% down payment. 580 plus would be a minimum of 3.5% down payment. This is great for first-time home buyers, but you do not have to be a first-time home buyer to do this product or to take advantage of it. Gift funds are allowed by a family member. If you are going to do gift funds, make sure that you let your loan officer know ahead of time, because there is a particular way that you have to source those funds. So you want to get that information ahead of time. And then you can be on your job for fewer than 2 years. However, you do need a 2-year work history. You can have higher debt to income ratios on an FHA loan. So sometimes it's a good product if you need to go, need to push those debt to income ratios a little bit higher. And then FHA is allowed on purchase 2 years after a bankruptcy is discharged or 3 years after foreclosure. So this is actually a great program for those of you that need to, that need a fresh start, that you're just starting over. All right, we have VA loans. This is for veterans only. Credit scores is minimum is 580. There's no monthly insurance premium, mortgage insurance premiums, no down payment for veterans, which is great. You can finance 100% of the purchase price. And a surviving spouse of a deceased veteran may apply or may be eligible as well. All right, mass housing down payment assistance. So this is available for first-time home buyers only. It is for single families, condos, and now they just changed it this last summer where you could do 2 to 4 family properties as well. First-time home buyers can earn up to 100% of the AMI, which is the area median income. And I'm going to give you that. That'll be on our next slide. I'll give you that information. And then first mortgage loans are financed at a fixed rate of 30 years. There are no prepayment penalties to pay it off early. The down payment assistance is a second mortgage. It's a fixed rate mortgage that's financed for 15 years at 2% interest. So a very low payment. But it does have to be paid back. It can be up to 5% of the purchase price or $15,000, whichever is less. So down payment assistance is due upon sale of the home or refinance of the property prior to the end of the 15-year term. So keep that in mind. You don't want to forget that has to also be included when you're selling your property, or even when you're refinancing. All right, you can also take advantage of conventional or FHA for the mass housing down payment assistance. So conventional loan would be, it's nice because it has discounted mortgage insurance premiums, which is great. It's a 5% down payment requirement, which is covered by the mass housing down payment assistance program, up to $15,000. And the minimum credit score on that is 680. Now, FHA, you can do the FHA. It requires the FHA mortgage insurance. So the upfront and the monthly is all going to be the same as it is on any other loan product. It is a 3.5% down payment requirement that's covered by mass housing. And again, that's also up to $15,000. Now, there is something different about the mass housing, the FHA mass housing down payment assistance, and that is because it's only a minimum requirement of 3.5%, and they do give you 5%. You can actually utilize the 1.5%, additional 1.5% towards your closing costs, or you can put it towards, bringing down your loan amount. So you can do either or. So it's a great idea for those of you that might be a little tight on funds for the down payment or for the closing costs, and it might help you in that regard. And then the minimum credit score on that is 640. So it's a pretty low credit score, and it's a great way to get into a property, but while using or utilizing that mass housing down payment assistance. All right, here's that income limit chart that I was telling you, first time home buyer income limits. So you can look and see which county that you're looking to purchase in, and it gives you those income limits. So now this is not per household. These income limits are per, whoever is on the loan. So this is great. So if every person in the household is not going on the loan, you do not have to include their income. There are certain loan products that make, that require that everybody include their income, but and this for the mass housing down payment assistance, they do not. All right, do I need to take a home buying counseling course? So it is required for mass housing that any buyer using the down payment assistance program attend one of their approved counseling courses. So you have the option to do the course online for a much higher fee, or you can go to www.masshousing.com and type in the search bar homebuyer education to get a list of all the approved home buying counseling classes, and then you can also get signed up. So keep in mind that each program has their own down payment or own home buying counseling course. So you want to find out, depending on the program that you're going to qualify for, which one is going to work for you, especially for these first-time homebuyer programs. Note that not all home buying classes are mass housing approved. So you want to use their website to search for all approved classes. Plan ahead and don't wait until you find a home, because you may not be able to get into the class that you need or that you want quick enough to match your closing date. So this is really important. We've had a couple of close calls with this. So make sure that you plan ahead and get it done now. And certificates are good for 2 years, so you have plenty of time to find a home. All right, how do you submit an application? So you can submit a short application process by going to my secured website if you want to apply with me at prmimass.com and click apply. You can also reach out to me at any time if you want to ask additional questions, find out more information. I'm here as a resource for you, so make sure that you do reach out to me. I look forward to working with each and every one of you in the future. Thank you, everyone. Be safe and be careful, and I look forward to hearing from you soon.